monetary policy panel, and what you see, only 2 panelists. So the nightmare of a chairman is materializing. Frank Smets is stuck anywhere between Amsterdam airport and this conference venue, but I hope he will make it in time. If not, we have 2 excellent panelists who can address the monetary policy issues from both sides of the Atlantic, I'm sure. On my right, we have Elga Bartsch. Elga heads up economic and markets research of the Blackrock Investment Institute. And the institute provides connectivity between BlackRock's portfolio managers. It originates economic and market research and publishes insights. For example, concerning a paper that is called Dealing with the Next Downturn, an analysis together with Stan Fisher and others that has attracted a lot of public attention over the recent weeks, and I'm sure you will talk about that too. Prior to joining BlackRock, Elga was global co-head of economics and chief European economist at Morgan Stanley in London, and she started her career as a research associate at the Kiel Institute for the World Economy, a large German economic think tank, where she worked at the President's Office and managed the advanced studies in international economic policy research. Then to my left, we have David Altig. He's the Executive Vice President, Director of Research of the Atlanta Fed. And in addition to advising the bank president on monetary policy and related matters, Dave oversees the bank's regional executives and the research department. He serves as an adjunct professor of economics in the Graduate School of Business at the University of Chicago, and he has really vast experiences of the Fed system because prior to joining the Atlanta Fed, he served as a vice president, associate director of research at the Cleveland Fed, so he knows 2 regional Feds. Before joining Cleveland, he was a faculty member in the Department of Business Economics at Indiana University, and he has lectured at various universities, colleges in the US and abroad. So I think that we will have about 15 to 20 minutes introductory remarks by each panelist. I will not introduce Frank because he's not here, but I will do it when he has arrived. And then we will open up to questions from you regarding the issues covered in the panel. So then I would ask Elga.
Thank you very much for inviting me to present on 2 issues here today. One is the lessons from the recent past on both sides of the Atlantic, but then also talk about frameworks for the future and the recent paper that we have published. So just to provide a quick sort of overview, what I'm trying to convey here is that when it comes to the recent experience, I think we saw a pretty abrupt stop of the monetary policy normalization process. Central banks on both sides of the Atlantic running out of appropriate tools to address the situation. As a result of a somewhat suboptimal policy mix, the decision-making bodies have become much more divided in recent decisions, causing some more confusion amongst market participants, potentially also feeding some market volatility. And so I'll talk through that as far as the recent experience is concerned, because one thing that I find striking in this is that despite the situation on both sides of the Atlantic being very different, there's a number of key similarities. But then I also want to take the time to talk to you about how central banks are currently rethinking their frameworks. I will stress that a number of things that are being discussed, especially maybe moving to a new form of inflation targeting or changing the target itself, requires a high degree of central bank credibility that might be in short supply. At the moment, and then sort of talk a little bit about how one could counter the next downturn by moving from unconventional monetary policy measures to an unprecedented policy coordination between monetary and fiscal policy, and that's indeed based on a joint paper with Jean Bovin, Stan Fischer, and Philipp Hildebrand. So let's get right into it now that Frank is here. The first thing we saw is that the marked increase in macro uncertainty on the back of the protectionist push of the US administration, a range of geopolitical tensions, and more generally populist politics interrupted the monetary policy normalization process. And we saw a pretty swift dovish pivot by central banks at the beginning of the year. Charlie Evans has spoken about this. Thus far, this has worked well. Financial conditions have become a lot easier. But I do think that central banks are running out of the appropriate tools. And interestingly, on both sides of the Atlantic. In the US, I think at the end of the day, what the Fed is facing is a negative supply shock caused by a sharp rise in protectionism. And unfortunately, central banks have limited ability to counter negative supply shocks. In Europe, the problem is different. The ECB is running out of policy space, and as a result, measures that get implemented are probably decreasing in their effectiveness and increasing in their side effects. So as a result, the policy mix on both sides of the Atlantic is somewhat suboptimal compared to sort of a first best solution. And as a result, I think it's not a major surprise that the decision-making bodies have become more divided about sort of the right course of action. We see basically on both sides a three-way split on what to do on interest rates, and in Europe also a number of the unconventional measures that were taken at the last meeting seem to be somewhat controversial. That I think is something that we sort of need to take into consideration, and given the disunity or divergence of views amongst the decision-making bodies, we also have seen that markets have started to reprice their expectation as to further interest rate moves on both sides of the Atlantic. Klaus already spoke about the decline in R star, and here you see sort of our estimates. We replicated both for the US and Europe some work that was done at the ECB, which basically looks at a slightly more granular version of R star, which postulates that you want to maintain an equilibrium both in the real economy and in the financial sector. And if you're looking at major re-leveraging or deleveraging phases, these two rates can diverge. In the US, the Federal Reserve was on course to get back to R star. Obviously, mission was aborted at the beginning of this year. And in Europe, the ECB continues to keep a very wide distance from R star, but thus far with limited success in terms of getting back to the inflation target. And as a result, I would say that in Europe, the need to act on monetary policy is probably even more pressing than it was in the US, because the ECB is missing its primary objective and has done so for a while. Reassuringly, our star gap is well away from the situation that has preceded past recessions, and with monetary policy easy, with fiscal policy being supportive, and with no major financial vulnerabilities building up in the system, the risk of a recession near term, in our view, is remote, but that nonetheless means that we need to think about how we could counter it if and when it comes. And what we have seen is now that central banks, given the challenges I think that Klaus very clearly sort of outlined in his comments, are starting to rethink their strategy. And that's basically along two lines. One is, should one move away from just single period inflation targeting to something that is average inflation targeted, temporary price level targeting, or even full-on price level targeting, or should one potentially change the inflation target? And all of these are important questions. My main problem with all of these considerations is really that central banks would need a very high degree of credibility in order to move around, especially in the average inflation targeting space, to really move around pretty aggressively the short-term inflation expectations with a view to anchor the long-term one near the target. And I think outside economic models, this might be quite a bit harder than it seems in economic theory or model simulations. Because what we see in markets, at least, and in surveys, is that, if anything, the markets are increasingly calling into question central banks' ability to return back to the inflation target that they have chosen, even over the really long run. And part of the explanation could be that some of this is just backward-looking. It's reflecting the extended undershoot of inflation dynamics below targets. But I think it could also reflect the fact that markets are increasingly aware that central banks are running out of ammunition. And one way to illustrate that central banks are not having enough ammunition to counter the next downturn would to basically focus on the interest rate channel. And I do think that quantitative easing, first and foremost, also works through the interest rate channel, and show that the interest rate channel is largely exhausted. And we do that by basically simulating the median yield curve in past recessions on both sides of the Atlantic, allowing for the decline in the natural rate. What you see if you look at these simple simulations is that on both sides you would need to be ready to push interest rates, policy rates, deep into negative territory below 2%. So that's quite firmly, I think, below most estimates of the reversal rate at the current juncture. Of course, some things could change, but that seems to be quite ambitious. Historically, the Fed has cut about 400 to 500 basis points in a standard recession, and the long end of the curve shifted down by around 100, 150 basis points. This is ambitious in the current environment. In Europe, we even see the German yield curve, at least, almost fully converged already to the standard recession shape that we would see here. So all stimulus that you could see coming through the interest rate channel in the euro area would need to come through the non-core part of the euro area. So why am I so concerned about central banks running out of ammunition? Well, first of all, because I do think it's a risk. Once you are out of ammunition, it's a major risk to central bank independence. How dangerous this actually could get, I think, very much depends on the nature of the legal, institutional, and political setup and the situation in the respective country. But a central bank that is no longer able to deliver on its mandate might find itself sort of in the grip of politics quite quickly. And one theater where we might observe something like that could well be the Bank of England, which, as you all know, was only made independent a little bit more than 20 years ago, and which soon will lose the protection of the EU treaty. So central bank independence is really at the heart of us thinking of how one could counter the next downturn, because we do think that central banks need to be on the front foot in order to avoid being dragged along by the other policy areas. Now, it is clear, and it has been said several times already today, that fiscal policy will need to play a bigger role. But on its own, it's probably not effective. One reason is that if we really had a major fiscal stimulus of the size that is sufficient to counter a full-on recession, you would likely see some crowding out, a rise in bond yields, interest rates more broadly, that would undermine the effectiveness of the fiscal stimulus in the first place. And that is why it might be necessary to match the fiscal policy stimulus by some sort of monetary financing. Now, that monetary financing could come from the central bank, it could come from commercial bank, it could come from state-owned development banks, for instance. But it is important that the money supply goes up so that you don't see the rise in interest rates, the crowding out that you could get otherwise. So in the last 10 years, I think what we have seen, and a number of people have talked about it already, is that a soft form of coordination between fiscal and monetary policy leads to suboptimal outcomes. And this is for a variety of reasons, and they differ from country to country. But that's, in fact, why in the paper we propose the creation of a standing emergency fiscal facility, a SEF, which is created by the central bank, and it's meant to provide a framework for the monetary financing by, first of all, defining the circumstances under which it gets activated. So it's the central bank that decides that. The purpose of the facility would be to meet the central bank's target, first and foremost the inflation objective. The central bank could help to define, to spell out a mechanism for nimble deployment of fiscal policy, and there are some examples, for instance, in Singapore, how this could be done. And most importantly of all, define a clear exit strategy. So it's the central bank alone that determines the size of the facility of the monetary financing, and it would calibrate it so that it believes that its mandate would be achieved. So that's based on the inflation objectives. And so the facility, we think, offers a possible path, and it's a stylized proposal at this stage, not relating to any particular country or region, but we hope that this would be a way, one possible way, to protect central bank independence in the next downturn, to actually enhance central bank credibility, because you show a way how you can get back to the central bank target. And then last but not least, avoid the pitfalls of modern monetarist theory, MMT, which some people of course also call the magic money tree theory. So that's in the essence the proposal we made in the paper. It's just the start of a debate. I'd be very interested to hear better ideas from others, but I do think that we need to think today on how central banks and policy more broadly can counter the next downturn.
Well, thanks, Elga. I think that provides a very good start for the discussion later, but I would now turn over to Dave.
Get my slides up. Well, thanks to Jens and all the sponsors for giving me the opportunity to be here and talk. That was pretty interesting. I'm going to say something less interesting, probably. I want to start framing my, I'm going to talk a little bit about the monetary framework effort in the United States. I'm going to start my comments by sort of giving an example of the challenge that sort of global development seemed to be presenting to monetary policy in the U.S. So here's a picture sort of been staring at for a long time. This is just the spread between the 10-year Treasury yield and the 2-year Treasury yield, and it's got a pretty discernible pattern to it. And this flattening of the structure, particularly as we got later in the cycle here, has engendered a lot of hand-wringing that I, of course, found a way to explain away by simply looking at these measures of 10-year term premium. So this is the New York Fed's estimate of the 10-year term premium, and you can see that for most of this period, you could say the following: whereas typically flattening of the yield curve in the past has been somewhat predictive of problems in the economy, this time is different. And this time is different because we have these sort of developments going on that are driving down term premium, and that's what's really being reflected in the term structure of interest rates. But if you look at that picture, that kind of worked until the beginning of 2018. And then it kind of stopped working. So one of my colleagues noticed that you could superimpose another picture on this. This is the German 10-year, 2-year spread. And since 2018, it's been relatively highly correlated with the term premium estimates. Well, what do we make of that? What we made of that is when we think about this structure of interest rates in the U.S., there seems to be something missing. And sort of the obvious candidate was some sort of global risk factor. So here's basically what my colleagues did, is they said, well, let's take this ACM model, this New York Fed term premium model, let's add a global factor, global risk factor, and in fact the proxy for global risk was the German spread. And it turns out that that thing looks important, and it looks important in sort of the following way. If you take these term structure models, this particular term structure model in any event, without the global factor and extract from it sort of the expected path of policy rates, it's up. But if you add the global risk factor, now it starts to look like things we see in the euro-dollar market, things we see in OIS rate yields, and it does indeed suggest that the term structure is giving you some message about a negative path of rates going forward, perhaps reflecting some concern about how these global risks are introducing into problems, potential problems for the U.S. economy. So I raise that just because I think it's independently interesting to know that we have to start thinking about these things in the context of the current environment. 2018, it doesn't seem like a completely arbitrary date. It's the first announcement of the tariffs and really the first shots fired in our recent trade tensions, as well as global softening commencing from there. The broader message here is just, it's no longer seems President Evans and I grew up at a time where basically you wrote down closed economy models for the U.S., and that was fine. The rest of y'all can do what you want. We're good. And that world seems past, and it's already been alluded to multiple times, and it didn't take these last 2 years to tell us, because I think it's widely accepted that this decline in the neutral rate and the then probability of continued flirtation with the lower bound is a global phenomena. The United States does not stand alone in this, nor is its circumstance orthogonal to what's going on in the rest of the world. And this is Vice Chair Clarida saying, these are the reasons that we've decided that it's a good thing to engage in the sort of framework analysis that's already been mentioned several times. Now, I think it's important to point out that the framework discussion, at least as it's being constructed in the United States, is sort of multi-dimensional. It really involves three things. It involves discussions about strategy, and then it involves discussions about the tools for implementing that strategy, and then it involves ultimately discussions about the communications of that strategy. I'm not going to project what the outcome of that discussion might be, not least because I don't know, and then secondly, not least, probably most, because I'd get fired if I did, so I'm not going to, so I won't venture there. But this has been a kind of a remarkably transparent conversation going on. So I'm going to not look forward, look back a little bit, and I'm going to look back a little bit in the context of this Fed Listens initiative that has been part of the framework initiative as it's been kicked off, and sort of notably some of the issues that came up in a conference that was held at the Chicago Fed specifically about these issues. So I'm going to touch on kind of the strategy bit, the tool bit, very briefly on both, and then the communication bit briefly as well. So there is a strategy that's published every year in January. It's called the strategy document or something like that, the Statement on Longer Run Goals and Monetary Policy Strategy, and it says the following. The committee's going to try, this is when they set monetary policy, here's what we're aiming for, mitigating deviations of inflation from target and employment from some assessment of what maximum sustainable employment is. When it looks at this dual mandate, it's going to treat these objectives equally. And by the way, the inflation objective is symmetric. They're as worried about being above as below target. If you look at those first two items of this, it's got a very Taylor rule-like feel to it. In fact, if someone in a classroom asked me to explain the Taylor rule, I might write those things down. As President Evans was talking about earlier, the last one starts to feel a little, the asymmetric goal part of it starts to feel a little bit less clear from these statements. And I will kind of succinctly state the issue as the following. When you say your goal is symmetric, well, one thing it clearly means, because it means it in the rest of the document, is we don't like inflation above persistently. We don't like inflation below persistently. But then as you operate, are you thinking more about converging always to the 2% target or averaging the 2% target over time? And I think different people obviously are going to have different views on that, and where some of the communication comes in on this then is to what extent can the committee or the participants more generally clarify that question, and then what language would be necessary and specification of these longer run strategies to make that clear. So that's sort of the strategy part. The tool part, if we define the current framework is easy enough to sort of state in terms of tools as well as the stuff we already have used. That's pretty straightforward. Interest rates. Balance sheet policies, of course, in the United States, balance sheet policies are much more restrictive in a sense than they are for the ECB or the Bank of Japan or the Bank of England. We can do treasuries, we can do MBS, and we get really exotic. We can think about the different maturities of treasuries that we might use, but it's pretty straightforward stuff, and then forward guidance. So an obvious question is that enough? You know, first of all, we are constrained by legislation to not be able to go too far out of range with the balance sheet policies, but we could think of things like negative interest rates and other sorts of forward guidance other than we've used. So the question is, did it work last time? Is this a sufficient toolkit? Well, it's kind of a tricky question, but here's sort of a way I might think about it. What would a Taylor rule, let's just use the Taylor rule as a benchmark, what would a Taylor rule suggest we should have done over the crisis and into the recovery if we had the option of choosing negative interest rates at will? And so this is a sort of standard, so for, Taylor rule aficionados, this is Taylor 1999 with inertia in it, meaning the committee kind of wants to do what it did yesterday in the setting of rates, but then adjust on the basis of an equal weighted concern for the deviation of inflation, the deviation of output. I'm going to take this thing off if I can. And what you use for the resource gap, here's the GDP is measured, the gap measured by the CBO, or the unemployment gap is measured by the CBO, and you get interest rates that ought to be somewhere for a long time between roughly 3/4 of a percentage point negative to -2%. Okay, with this benchmark. Did forward guidance and the balance sheet policies together implicitly deliver something like that? Well, here's one way to look at it. This is the Wu-Jia shadow rate. This is just one of many measures of a shadow rate, which basically uses the term structure and forward rates to back out, what was the effective short-term interest rate, looking at the effects on longer-term interest rates that these policies engineered. And if you believe any of these calculations, then the answer would be, well, early on, it looked a little timid. Maybe not because a more aggressive stance wasn't possible, but because, everyone's learning and don't know a lot about these tools, don't know a lot about the cost of these tools. There's some caution. But later on, policy becomes actually quite stimulative, and certainly more stimulative than would even be suggested by these rules. All right, so I kind of rigged the game there. You knew I was doing that because I picked a couple rules where this thing looked pretty good. If I had picked a different sort of Taylor rule, we'd be nowhere in the ballpark except really late in the recovery. Or if I were to take an outcome-based approach, you might say, well, all right, maybe you did, and think about the evidence of Eberle, Stock, and Wright that was presented at the Chicago Fed conference. It was sort of, yeah, you probably did okay on the unemployment, but you really missed the inflation stuff, so your tools, as they were deployed, didn't quite do the trick. So could they be deployed in a more aggressive way that would do the trick? And I'm not going to answer that question. That's one of the questions that would be on the table. I'll make a couple points with respect to forward guidance in particular. So early on, and sort of by the time this forward guidance idea, so, just like the ECB, I think, we went through several flavors of forward guidance. It was qualitative, and then it was date contingent, then it was state contingent. The idea, by the time we get to, I guess, about 2012 or something, Mike Woodford gets up in Jackson Hole, and he says, well, this is the way you guys ought to think about this. Here's the real key of this forward guidance stuff is to convince everyone that you are going to stay lower for longer. And lower for longer materially meant you should be holding rates low beyond the point that a standard rule would tell you they ought to be low. Well, I've sort of juxtaposed here the actual funds rate path with one of those Taylor rule paths. I actually could have chosen any of them, and they would have told you the same thing. Woodford doesn't look like that the Woodford rule didn't carry the day. Basically, if you look at this, it looks almost exactly like a Taylor rule was what was implemented. Maybe Woodford was right, and should there be some way to credibly commit, if you can do such a thing, to the lower for longer in a real sensible way. The state contingent, I will say things like the state contingent, the unemployment rate thresholds. They were always thresholds. We won't raise interest rates at least until we've passed an unemployment rate of 6.5%. Did anyone believe otherwise? That's sort of what this picture is about. Are you behaving exactly like people think you would behave in normal times, or are you really implementing an extraordinary policy to deal with the extraordinary circumstances of being at the lower bound? That's one thing. The second thing is with this forward guidance is, well, I think we did learn a lesson. And again, I'm going to reference President Evans, not just because he's sitting here, but it probably doesn't hurt that I can butter up a president, who brought up this idea of Delphic forward guidance versus Odyssean forward guidance. Are you actually, when you say something about how long you're going to hold interest rates low, are you saying something about the state of the economy, or are you saying something about binding yourself to an extraordinary policy path? And this is the sort of results from, the picture itself doesn't show you any results really, other than simply when these episodes occur, and they occur in close proximity to one another. But Del Negro, Giannone, and Patterson argue, and I find the argument somewhat convincing, that when forward guidance was coupled with a negative statement about the economy, that didn't work so well. When forward guidance was coupled with sort of the notion that, yeah, everything looks, reasonable enough, but we want it to look better, and therefore we're going to keep interest rates low, then we seem to get the effects on longer term rates that we wanted to have. So as I said, I don't know what the outcome of all this stuff is going to be. You can bother President Evans at the break, and maybe he'll tell you, but this is a moment I think you should take at their word that basically almost everything is being considered. Vice Chair Clarida at the beginning said, everything's on the table except 2%. Except 2%. And we'll see how it comes out. So thanks.
Well, thanks, Dave. Well, there's Odyssean forward guidance, and I think at least one panelist had a kind of Odyssean experience today, but I'm glad that you made it, you arrived, Frank Smets. You do not need an introduction in Frankfurt, but I will give one for people outside of Frankfurt. I think Frank is the Director General of Economics at the ECB, and he's also the Chairman of the Monetary Policy Committee, so he's my chairman, so to speak. And whenever you hear the President of the ECB telling at a press conference that the Governing Council has tasked the relevant committees, you know that Frank has some work to do, and later on we too. prior to that, and because that's not new to him, that he has to follow the president. That's not a new experience, because before his current position, he was advisor to the president from 2013 on, and before that, head of research. He is professor at the University of Ghent. He has published extensively, and we are very happy to have you here, Frank. The floor is yours.
Thank you very much, Jens, for a very kind introduction. It's a real pleasure to be here, and I'm very sorry that I have missed the important speeches and presentations earlier this morning. So I feel like I'm talking a little bit in a void, but I think both Elga and Dave have set the stage, and I think I will follow in their footsteps, but take a somewhat different approach by reporting on some very preliminary analytical work that tries to address some of the issues that were discussed before. So I will take up Jens's invitation to reflect more on the strategic monetary policy issues. I will not talk in this presentation about the most recent decisions, but I'm happy to do that in discussion if there are questions. Obviously the Fed is going through a big review exercise, and I'm sure Charlie and of course Dave have talked about that. You probably also know that the new president-elect, Christine Lagarde, in her hearing before the European Parliament, has also more or less announced that she will have a review of ECB's strategy as one of her sort of objectives early on. But obviously we haven't started yet. We're still very early. I mean, we have had some reflections already in our Monetary Policy Committee, but I can't really say much about that because this is for the future. But what I have done is, with some colleagues, is starting doing some preliminary work, and this is what I want to talk about. And so the main issue that we're trying to address here is, given that we sort of all agree, or at least many of us agree, that there has been a fall in the equilibrium real interest rate, to what extent does that hamper the effectiveness of monetary policy, standard monetary policy, to stabilize the economy? And so there are different ways in which you can do that. You can look at history, like Dave did, but you can also look at your models and use that as a laboratory to see what are the implications of a lower equilibrium real rate for the effectiveness of monetary policy, and what are the outcomes? Does it really distort the economy? So that's one element. And the reason why, and of course this reason, the lower bound, was one of the justifications for the decision in the 2003 review, which under the leadership of Otmar Issing, for the Governing Council to decide that it would aim at an inflation rate close to 2%, rather than close to 0%, which would also be in line with our definition of price stability. So things have changed. One is the equilibrium real rate has fallen. The other thing is that the great moderation has disappeared, or at least there's a bit more uncertainty, and sort of the volatility of the macroeconomic shocks has definitely increased since with the great financial crisis. And so also that, of course, puts a challenge to this ability to stabilize. But the third thing that has changed is that we've used unconventional monetary policy. We've used forward guidance. We've used large assets purchases, large-scale asset purchases. We went negative in the euro area. We had lending to the bank, direct lending to the bank, the TLTROs and so on. And so when trying to address that question, how does the lower real rate and maybe more macroeconomic volatility affect the effectiveness and the ability of monetary policy to stabilize the economy, we also have to take into account that we have learned quite a bit about these other tools and their effectiveness. And so one question then is, will those tools be able to compensate for the fact that the short rate cannot fall to to minus 5% as some of the rules that they've showed would suggest. And so that's the exercise that we want to do, but we want to do it into a model. Now, for that you need a model that actually can also speak to the effects of forward guidance, that can speak to the effects of large-scale asset purchases, that can speak to the use of fiscal policy, and of course that's where I would link to Elga's recent paper, which suggests that fiscal policy needs to take a stronger role. So you can also look at to what extent what we call in the paper state contingent fiscal policy, so fiscal policy that would kick in whenever there is a gap between the interest rate you would like to set and the interest rate the central bank can set, to what extent can that also help? So that's what we're trying to do, and I will obviously not go into the details of the exercise, but I do want to give you a number of tables that show to what extent this is a problem, again, according to this model-based analysis. The model that we will use is basically one of the main macroeconometric models that we use. It's called the New Area-Wide model, developed by Günther Koenen, one of my colleagues, and other colleagues. And we have basically a new version of that model, which tried to incorporate some of the lessons we've learned from the crisis, that the financial sector matters. So many of you here matter. So we included a general role of financial intermediaries in the propagation of economic shocks. Unfortunately, the financial sector is also a source of shocks. Actually, that's one of the reasons why we get more volatility in that new version of the model. It captures a prominent role for bank lending rates, which is of course very important for the euro area economy. And again, for our exercise, it's important that it's also a structural framework that can assess the macroeconomic impact of the ECB's large-scale asset purchases. And so in terms of the estimation of the model is such that more or less it can replicate some of the estimated effects that of course there's a lot of uncertainty about that, but sort of the medium estimated effects that many econometric studies have shown about QE, about large-scale asset purchases. Okay, let me not talk about, now, which policies do we look at? No? So we'll try to see, first of all, what is the effect of lowering of the equilibrium rate, and the fact that this nominal interest rate buffer becomes smaller, basically from 4% to 2%. And so if you typically need a drop in interest rates in typical recession of 4 percentage points, then obviously you will be constrained more. But which policies can be used to offset that? So the ones that we will look at are first what we call state-dependent forward guidance. So, and it is of the sort of more the Odyssean, in the sense that these are rules, I will not go, but this is the mathematical presentation. It basically says that whenever there is a gap in terms of Dave's graphs between sort of the Taylor rule that you would like to set and the effective lower bound, basically you will promise to keep interest rates a bit lower than is implied by that rule. Again, you have to calibrate those rules in a certain way. So far we haven't optimized those rules, so we just took ones that we thought were reasonable, so that don't promise eternity, but promise some extension of keeping low for longer beyond what the Taylor rule, the normal reaction function would suggest. So that's what we call state-dependent forward guidance. And then we have, and actually we will have two versions. You will see in the tables, we have what we call a fully credible forward guidance. In this model, expectations are quite strong transmission mechanisms, and you may worry about the fact that this may not always be believed, this forward guidance. So we have one version where it's fully credible, another version where we call weak forward guidance, where only a share of kind of the agents in the economy actually believe the central bank when it announces that policy rule, and the other part is just sticking to the Taylor rule. And then we also have a rule which is called enhanced forward guidance, where actually asset purchases are combined with forward guidance, and asset purchases play the role of increasing actually the credibility of the forward guidance. Again, it's a bit mechanical the way we do it, but the idea is to try to capture also the synergies between asset purchases and forward guidance. And then we also have a state-dependent asset purchase rule. So again, that's the mathematical representation, but basically what it says is, again, whenever there's a gap developing between what the Taylor rule would suggest and your effective lower bound, you start purchasing assets. In our model, this will be government bonds, so we don't look, well, it's not even clear exactly what it is, but let's call it sovereign bonds. And then so there's some persistence, and it stops when the gap is back to zero. But because of this persistence, no, it will go on for some while. And then finally, we have state-dependent fiscal stimulus. And this very much, to some extent, is one way of capturing in a model the proposal that Elga and her colleagues made. But of course, she put more emphasis also on the institutional structure. But it's basically fiscal policy that would kick in whenever this gap develops. Okay, let me then show you some tables. So first, to kind of show you, at least according to our standard macroeconometric models, this is a real issue. It's a real problem. So this basically backs up Rich Clarida's, the Fed chair's statement. The reason why we want to have the review is the lower equilibrium real rate. So what this table shows is outcomes of these model simulations where we shock the economy to many of the shocks that we've seen over the past 20 years. And the two policies. The first block is called, or let's talk about the last block. The last block is without an effective lower bound. So that's a counterfactual where you assume interest rates can go negative very much, and they have the usual effects. Now, then we can discuss whether these effects would be the same as in positive territory, but that's another question. You can see from the lower panel, I mean, when you lower the equilibrium real rate, the R star, from 2%, so that's the fourth line, to 0%, the last line, nothing changes in terms of the performance of the economy. Inflation, which here, for all practical purposes, we assumed 1.9%, the inflation aim is 1.9%. The output gap is on average 0. There is some, of course, variability, and not actually quite a lot of variability around that, but that just comes from the fact that you have unexpected shocks, and it takes time for policy to be able to counteract that. But the fall in equilibrium rate doesn't really pose any problem from a macro stabilization perspective. When you impose the effective lower bound, and I should say that, because this is simulations for the euro area economy, we actually, in the simulation, we assumed 40 basis point lower bound. Now, of course, in the meantime, we went 10 basis point lower, and you could argue that, obviously the Governing Council has signaled that it could even go longer. Some of the results would of course change if we lower the effective lower bound. But anyway, when you impose the effective lower bound and you keep the rule, which is basically the estimated rule in our macro model, unchanged, so whenever the gap emerges, you keep the interest rate at the effective lower bound, and then as soon as the rule says interest rates can lift off, you start lift offing. So this is without low for long or forward guidance policies. You see there's a big impact in this model on the performance of the economy. Even actually at a real rate of 2%, which was closer to what we thought the real rate was 10 years ago, you get a negative bias. So it is a bit different from the results that we had in 2003 when we did similar exercises and concluded that a close to 2% inflation aim basically was enough to offset sort of distortions coming from the lower bound. And you create a negative output gap, sort of a persistent lower output level. I mean, it's not very large, but it's there. But as you go to zero, which arguably some people would say is closer to the current estimate, then actually, if you don't change policies, you actually would have on average a distortion of more than 3 percentage points, a negative inflation rate. Again, if you believe this model. So this model basically suggests it is a real problem. And of course, similarly, you have an output gap. Now then the question is, and of course that's part of the simulations and reasoning that some economists, like Olivier Blanchard and others, have used to say, okay, we need to increase the buffer, from 2 to 4%. The question that we want to ask here is, well, are these results still true if you actually take into account that we have all these other tools and the fact that we can do forward guidance, that we do have an impact on the yield curve, that we can compress the term premium through our asset purchases, and that way have a stimulative impact of the economy. And this is basically one set of results where we focus on the case without forward guidance. So this is just asset purchases and fiscal policy. And you see, again, this is not optimized, so I'm sure we can do better but then again, no, we shouldn't take these results, too seriously. It's more a qualitative and a tendential sort of conclusions we can take from that. But anyway, you see that if you compare it with the previous, that indeed you have a significant improvement of these distortions, but there's still a bit of a problem. If you think the real rate is at zero, actually we would still have on average inflation around zero and a relatively big output gap. Again, it's -8 versus -12, so it improves. Similarly with fiscal policy, the state-dependent fiscal policy helps, and it helps actually better, again, under our calibration than asset purchases, but there's still a bit of a distortion in the economy. If you use both, not surprisingly, then you have the best effects within this set of policies. Again, don't take these results as too seriously. It's a first exploration of some of the effectiveness of at least these tools in a sort of model context. Forward guidance actually seems to do a much better job, and I think that is to some extent related to the fact that our models, where forward-looking expectations are quite important, still suffer somewhat from what some have called the forward guidance puzzle, that actually effectiveness is too strong to be true. Particularly if we do so full credible forward guidance, more or less we get back to 2%. Again, there's still a deviation, but probably within the margin of error of many of the parameters and of this exercise. Weak forward guidance actually also works relatively well, and enhanced forward guidance with strong asset purchases is one of the best strategies. Partly also because when you do that, when you combine the instruments, of course, then the time at which you spend at the lower bound is somewhat reduced. So if you worry about low for too long, then you may think a combination of measures, as the Governing Council has decided 2 weeks ago, may be more appropriate than trying to push just on one of them. Of course, then when you do these models, you can look at, okay, how much purchases would it take? How much fiscal stimulus would it take? We have some numbers here. Again, not to be taken very seriously, but they're in the ballpark of what central banks on both sides of the Atlantic have undertaken. So just some summary and conclusions. According to this analysis, the effective lower bound gives rise to quite significant costs if unaddressed. And so it's important to kind of, given this to review our strategies and see what we can, whether we can address it and how we can address it. The adverse effects of the effective lower bound on the model steady state distribution are larger, the lower the equilibrium real interest rate. So knowing and also not only what the current equilibrium rate is, but what it will be in the future is sort of important for these type of exercise. And of course, everybody, I think many people agree that it has fallen, but if you ask where do you think the equilibrium real rate will be in 10 years' time, I mean, you get possibly very different answers. It depends on what you think the increase, I mean, the effects will be of the demographic transition, of population aging, will depend on whether you think the productivity growth, which is very low now, will actually rebound, and whether things like the new digital technologies will eventually lead to higher productivity, and so on and so forth. But if it's low, it stays low as it is, then the ELB incidence, so the time that you spend at the lower bound, basically increases from 6 to 16% as the interest rate falls from 2 to 0%. And again, the stabilization of the economy is because of that impaired. Asset purchases and fiscal stimulus by themselves do redress part of the distortions, but in our simulations we were a bit surprised by the fact that they don't do the full work. Particularly for fiscal policy, we were a bit surprised because there's a lot of research that says that particularly when interest rates remain low, that the multipliers of fiscal stimulus are larger. And again, this is so just the first thing. And then finally, forward guides on interest rates is most powerful and can largely undo the distortion effects due to the effective lower bound. Let me stop here. Thank you.
Well, thanks, Frank. I think the three panelists have done a wonderful job. They've put nearly everything on the table what you can imagine to discuss when it comes to future monetary policy frameworks, future setting of monetary policy. We have a couple of minutes left, and I think there must be many questions from the audience. So the floor is now yours. Professor Südekamp?
So sorry, I have a question for Elga, because if I understood you correctly, you were asking for major fiscal stimulus accommodated by monetary financing, at the same time mocking the post-Keynesian MMT. And my question is just, what exactly is the difference between your proposal and that program?
Well, I think we can collect maybe 3 questions. Felix?
Yeah, 2 questions also to Elga and on the fiscal side. Can you be a bit more specific about this facility? So is the idea when you draw the fiscal facility that you then leave it to the politicians to implement that, or would the facility have specific measures in place that you want to see in terms of multiplier and timing? And the other question would be on your neutral rate chart. If I got that right, you had an increase in the neutral rate for the Eurozone over the past years. Could you say what was driving that?
Klaus?
So this would be a question to Frank. So I was just wondering whether, your model didn't have a monetary union, really. If you entertained the notion that maybe the natural rates differed across union countries and were probably higher in some countries than others, and that those countries are also the ones that, with a higher growth rate and a higher natural rate, have the fiscal space, then the effective lower bound would be felt differently across the constraining forces of the lower bound would be felt differently across the Union. And then the question is whether you really get the sort of state contingency that you are looking for in fiscal policy from non-coordinated fiscal policy. And it would be just interesting to hear how optimistic you would be that this is actually something that will happen.
I think that concludes the first round, and then we'll have a second round of questions. Who will start? Elga?
Yes, thank you very much. So on the difference between our proposal and MMT, the difference is twofold. One is that MMT really sees the central bank as a subdivision of the Treasury in charge of basically keeping interest rates as low as possible. Our proposal tries to put the central bank in charge and define the parameters of the monetary financing part of fiscal policy, which could be only part of the overall fiscal stimulus, because there might be other political reasons why you might want to do more. For instance, going beyond the near-term cyclical situation, investing in infrastructure and sort of low carbon future, for instance. So those are the two key differences. We're putting the central bank sort of on top of the decision tree, and we also are aware that extensive monetary financing of fiscal expansions will have consequences, actually desired consequences, which is bringing inflation back to target, and that's exactly how this thing should be calibrated. And I think the proponents of modern monetary theory would see this a little bit differently than we do. On Felix's question regarding the facility and the specific measures, I think the central bank could advise on some channels that allow quick mobilization of the fiscal stimulus, but otherwise the exact nature of the fiscal stimulus would need to be decided through the normal budgetary process. But then sort of how to sort of speed it up so that it reaches the private sector or the public sector quickly, I think the central bank might have a few views. On R* in Europe, the increase is exactly coming from this extra feature of our estimate of R*, which is not just the economy at steady state, but also the financial system at steady state. So as Europe sort of came out of this phase of pretty aggressive deleveraging post-crisis, that suppressed the R* way below the traditional Laubach-Williams approach. And now that the financial system is in better shape and we're no longer aggressively deleveraging, the version of R* that keeps both on track on a steady state, the financial system and the economy, converges back to the traditional one that only looks at the real economy in a steady state equilibrium.
I think Frank.
Oh, Frank. Yeah, sure.
Okay, on Klaus's comments, I mean, on the monetary union, I mean, it's clear that sort of the common monetary policy stance, whether it's set by conventional interest rate policy or unconventional measures, may not be the appropriate one for every single country in the monetary union, and is likely, also in the face of the heterogeneity that is still there, to be too tight for some countries where unemployment is still relatively high, and too easy for some other countries where unemployment is now very low and inflationary pressures are picking up. Whether the fact that we have a lower bound and so on complicates that's an interesting question. And of course it has raised sometimes calls for unconventional monetary policy to be more sort of region-specific, which is not something that we've done, in the sense that our unconventional measures are geared at the euro area as a whole, although sometimes their use, of course, has differed, like the TLTRO across regions. But that case for doing that would be even stronger if we, for example, find out that at the lower bound, some of these divergences may become self-fulfilling or maybe strong. But I don't really have sort of an answer. I think it's an interesting question. On the non-coordinated fiscal policy, I mean, obviously that is an issue, a general issue also on fiscal policy in the monetary union. It's one of the reasons why at least the ECB and President Draghi has called repeatedly for also having a euro area-wide fiscal capacity that would sort of overcome these possible coordination problems. At the same time, I would say that in the current context, the country that, of course, is suffering most of the slowdown is actually this country, Germany, which has the most fiscal space. So maybe there's actually a good time and a coincidence of once between the euro area, the need for a euro area fiscal stimulus and the sort of country-specific interests.
Okay, I think we have time for a second round. Mr. Siegenthaler.
Yeah, thanks very much, Bert Siegenthaler, UBS. Just two questions, if I may. The first one for Dave and for Frank on forward guidance. Just wondering whether really forward guidance is a standalone instrument as such for monetary policy, because what if you are in a situation where the curve is just totally flat or possibly even inverted, and then, well, you just say you will keep doing what you're doing, but the market is anyway kind of assuming that even more than that possibly. So if you are kind of at the limits of monetary policy in terms of say rates and QE, or the perceived limits, is forward guidance still useful? And the other question for Frank, since you kindly offered to still mention last week's decision as well. Just one thing that particularly in the market people are debating quite a lot right now in terms of the negative rates and the tiering that was introduced. I'm just curious what your perception were now 2 weeks after, because there has been a little bit of a view that maybe this has diluted negative rates. It was kind of a stealth rate hike, some have argued, because it has in certain countries actually pushed up front-end rates. Was that an early signal that actually on the rate side maybe the limits are closer than we thought? Thank you.
Mr. Fromler.
Thank you. I have a question that is a little beside what we've been talking about now, but it has to do or may have to do something with monetary policy in the future, and that is how is it going in developing something when it comes to the application or consideration of behavior on financial markets. Behavioral finance is a topic that is not without interest, if we put it that way. We had two Nobel Prize winners dealing with that stuff. And is there anything happening? Is there anything that may be included in the future from behavior more in central bank decisions? Are the tools created? Thank you.
Don and the gentleman in the back then.
So if we were to implement a state contingent fiscal stimulus, is there on the flip side a state contingent fiscal tightening that would have to be built in, or has any thought been put into how that might be an exit?
Thank you. Stephen Sexauer. Question on the state contingent fiscal stimulus. In President Evans' talk, he mentioned that there's things you'd like to see, but it's not within your brief. It can be a fiscal issue, an immigration issue. Am I to understand that the view of this is that if the fiscal policies aren't being implemented, or there's a strategic goal, as in Christine Lagarde's application, that now the central bank brief has been expanded and armed to fulfill those roles?
Okay. Do you want to start, Dave?
Sure. So to the issue of, what do you do when you got, how does forward guidance work when you have a flat yield structure? I mean, and this is sort of to both of these issues. Look, I mean, it's still the game is to basically extend the period of time where that structure maintains beyond what would normally be the case. So you get you support stimulus. So is forward guidance a sufficient tool? Well, in our models, it's more than sufficient. I mean, it is the tool really that works on these things. The limitation of the analysis of this stuff has to do with it requires an awful lot about your capacity to control and influence expectations, and to the extent that that is problematic, the channel is going to be very, very much weaker, no matter where you're at in terms of the structure of interest rates. I think it's an interesting question, whose expectations are important in this kind of game. Eventually, this is sort of going to be about inflation in some way or another. So is it just financial markets that you have to convince what you're doing? Is it just people who set wages that you have to, or is it everyone who walks into a store and does spending? And I think we're a ways from understanding the limits of everything we're thinking about outside of kind of rational expectations or quasi-rational expectations environment.
Yeah, so just sort of on the behavioral finance or science point, I mean, as far as these things drive financial markets, I think they are already included in central bank decisions because they form part of the transmission mechanism. I'm wondering whether you're referring to something like an app that would always remind German citizens that they have a lot of money in the bank account and should spend it, and maybe in another country where debt is rising too fast to remind people that they actually already have quite a bit of debt. So maybe that's an interesting idea to create more cohesion in the euro area, but I think in terms of digital developments, that's still a while off to basically mobilize the nudge idea that is, being discussed in government circles in many countries to that extent. So I'm not entirely sure. On state contingent fiscal tightening, what would happen in our proposal is that the monetary financing ends, and as a result, then the funding costs would start to increase, and that probably would sort of cause a rethink of fiscal policy, of the fiscal policy outlook. In terms of the expansion of the role of central banks, that's not really what we have in mind in our proposal. It's really just coordinating more effectively and with an explicit framework between money and fiscal policy as is, and just ensuring that there is an increase in the money supply that accommodates fiscal stimulus to prevent the interest rates from going up materially, and that ensures a faster convergence back to the inflation target.
Okay. Well, first, Beat. standalone instrument. I mean, clearly, if there is a lower bound on the short rate, there must be a lower bound on expected short rates too at some point. Now, of course, many asset prices, including bond yields, also include term premium, and also there, of course, we've seen more action than maybe we thought was possible. So far, I have been surprised by how big the endogenous reactions are still to changes in the outlook of inflation and economic activity. At some point, no, this may no longer happen, but so far, nothing to complain about, and so it is working quite well. And again, the name of the game for us is to make sure that those who price understand our reaction function, and that's where, of course, the forward guidance statements of 2 weeks ago have been important. Having said that, we do believe that, and again, that has been reflected in the decision 2 weeks ago, that there are synergies between the different instruments, partly because they work through different channels. No, the asset purchases work more through the term premium, but they also reinforce each other. The asset purchases probably also strengthen the signaling channel on forward guidance on interest rates. And of course we also have the reinvestment, the TLTRO, which help on other margins. On negative rates and tiering, I think here we have to distinguish, I think, two things that happened. I mean, the first thing that happened was there was a repricing of future interest rate cuts. There's different theories about why that happened. Somehow, I think the market perceived this as, this is it. It's not it, and I think our chief economist, Philip Lane, also the president, subsequently have been clear. I think the president even last Monday, when he said all the parts of the instruments, of the package, are there to be calibrated if necessary. The second part is the impact of the tiering on the working of the interbank market. There, I think there's a lot of confusion, and also it's the first time we do it. But I mean, the macroeconomic impacts there are relatively limited. No, we're talking about basis points, not about. So in the big picture, this is not an issue, and in my view, it's a bit of an overreaction. I think that the money market can deal with these type of redistribution of sort of the quotas under the tiering. But okay, that remains to be seen. But I don't think it's a big monetary policy issue at the moment. Behavioral finance, in our macro models, so the results I showed are with sort of a standard DSG model, which of course one set of models. We have developed, and actually we just published a working paper, a new we call a semi-structural model, which is, I mean, I don't think it's more behavioral, it's more, but it's less tied to sort of the rational expectations model, and in that sense can more easily also take into account behavioral elements, which will be important to see how robust some of our exercises are to different transmission channels and different importance of expectation formation of different agents. And then finally on the state contingent fiscal stimulus, I think there are many questions about both the proposal and more generally about the effectiveness of fiscal stimulus. I mean, I think one of the reasons why it may not work as beautifully as some people may think in the simulations I show is that there is actually sort of a debt stabilization rule in our model, and so at some point, you cannot have ever increasing debt. And of course, that's one difference with proposals that really, I mean, think helicopter dropping type of proposals where basically the central bank balance sheet would permanently increase. I mean, all these things really need to be studied more. They were studying, but I think, again, as President Draghi said, on Monday, we haven't really studied them yet.
Well, then I would thank all panelists for their presentation, for the discussion. And in setting up a conference in Frankfurt, you are confronted with one challenge, and that is the sudden disappearance of the audience after lunch. And what you can do against it is keep the most interesting issue for the time after lunch, and that's what I've tried to do when we invited experts to talk about digitalization, which I promise will cover a wide range of issues of a topic everybody is talking about right now. And so I would ask you to come back at, let's say, 3 o'clock. So thanks.